Good afternoon, everyone, and welcome to today's webinar. This is the second Outlook webinar we are presenting in place of the canceled 2020 Rural Economic Outlook Conference. Today, Extension Agricultural Economist Dr. Rodney Jones will discuss the Ag Finance Outlook for the Southern Plains region. Viewers may ask questions at the end of today's presentation using the chat window. Click the chat button at the bottom of the screen to open the chat window and ask questions. Viewers may find additional farm management resources on the eFarm Management website, and I will share this link in the chat window. Dr. Jones, I will turn it over to you now.
Thank you, Brent. As Brent mentioned, we're kind of doing this webinar series as at least a temporary substitute for the Rural Economic Outlook Conference that we like to typically hold in the fall of the year. Hopefully we can get back together. I see a lot of names on the list of participants here today that I recognize, and certainly good friends that I wish we could interact face-to-face. I'm hoping that will happen sometime very shortly. But in the meantime, we wanted to present at least some of our standard Outlook presentations that we normally do at the conference, and we normally do on a routine basis throughout the year to just kind of fill everybody in where we're at in the ag industry. Again, we apologize for the fact that we had to go to a system of having people register for our conferences at least until we figure out what the problem is. To make a long story short, we've had a few instances within the OSU system of people Zoom bombing Zoom conferences that didn't have a registration associated with them, and that's not a very pleasant experience for either the presenters or the viewers of a Zoom conference. Some of that stuff is just really ridiculous. So we're trying to alleviate that, and at least temporarily, our solution is to have everybody register for the conference so we know who's going to be attending, and hopefully we won't get Zoom bombed with nasty stuff in the middle of the presentation. Since I'm looking at my PowerPoint slides, until I stop sharing those slides, I'm not going to be able to see the chat box. So if you have questions as we're going along, type those into the chat box or hold them until later. When I'm finished with the slides, I'll look at the chat box, and we'll of course have a little brief survey that we would like for you to fill out at the end of the webinar. So with that, I think I'll just jump right in and start sharing a little bit of what's going on in the ag finance world, in the world of agriculture, finance, and economics. So in order to do that, first, I'm going to look at the very big picture, just a graph. Many of you may have seen this in some publications. This is the latest forecast that came out about a couple of months ago from ERS, looking at net farm income and net cash farm income. So again, big picture across the whole United States. And then later on in the presentation, we'll talk about what that might mean for Oklahoma, or more generally Southern Plains agriculture. So a couple of important points that we look at here as we look at this graph. Both cash farm income and accrual net farm income in the aggregate across the United States have been moving higher for the last few years, and at least the current forecast, and this is a pretty solid forecast at this point in time, the forecast for 2020 is going to be a fairly dramatic increase, at least in accrual net farm income, the one that's really, really important to look at. We're not at the record levels that we saw like in the 2011 through 2013 time period, but we're certainly looking at a level of farm income that's well above average, even after adjusting for inflation. First, talk about maybe a little bit of the difference between the cash income number, the yellow line on the graph, and the blue or greenish colored line, which is true accrual net farm income. You'll notice that the vast majority of the time anyway, cash farm income is always higher than accrual farm income. On average, the difference there would be the depreciation component. Another difference is going to be the inventory adjustments, the selling of items aggressively in one year that were produced in another year, or vice versa, the holding inventories over until the following year before they are sold. And the same thing on the expense side, the pre-purchasing of major input items like fertilizer, feed, and fuel. One interesting thing to note is that in periods when accrual income, true accrual adjusted income, is rapidly increasing, the difference between the cash income and the accrual income tends to narrow. We saw that happen back in 2011. We saw it happen back in 2004. We're seeing that happen again here as we approach the end of 2020. That's because people slow down the aggressiveness of their sales. They're trying to delay, defer paying taxes on grain sales, livestock sales, etc. Or maybe they're aggressively purchasing inputs for the upcoming year. So we see that as a result of a tax management strategy. Those two lines tend to converge when we have rapidly improving net farm incomes. We're seeing that happen here as we get to the end of 2020. A huge component of both cash income and accrual net farm income as we approach the end of 2020, a huge component of that has been a government influx of cash, massive government payments coming into the ag sector in 2020. And we'll talk about that in a few minutes. That's not the only thing that is contributing to improved net farm income across the United States, but it's certainly an important factor. So some things to kind of look at. U.S. net farm income has been slowly improving for the past few years. Things didn't look very good back in March, April, and May of 2020. As a matter of fact, we were looking at maybe a reversal of the trend of slowly improving net farm income early in 2020. What a difference just a few months makes. Here's we approach the tail end of 2020. It looks like we've had a dramatic overall improvement in just a few months. And again, a big share of that attributed to a large influx of cash, as portrayed here on the next slide. Government farm program payments to farm producers going all the way back to 2010, a relatively steady line there for a good many years. So we got into 2019 and then again in 2020. A very large direct infusion of cash. As you look at the contributing components of that, not a tremendous increase in the component that is directly tied to crop prices, some market facilitation payments, but a huge influx of cash that is just a direct payment. The COVID-related payments, etc., really came into play here in 2020, representing $35 billion plus, the largest influx of cash into the ag sector, certainly in recent years, even in real dollars. So another thing that is very real and is a long-term impact has been a reduction in many of the expense items in agriculture as we've gone through 2020. Overall expenses coming down both nominally and in real terms. And we'll look at some of the components that are contributing to that. Nitrogen fertilizer prices, kind of a big item here. The phosphorus fertilizer products have jumped back up in price very recently, but still lower than many recent years. Of course, fuel for any agricultural enterprise that fuel is a big component of, that's been a big factor here in 2020 and appears to continue to be a big factor as we approach 2021. Interest rates, surprisingly low, a dramatic decline through 2020. And even the chemical and seed prices, while we're not seeing a dramatic decrease in those items, we're certainly not seeing any upward pressure either. Prices about the same for most of the purchased seed components, the soybean, the corn seed, those types of items, and most of the chemical components, prices remaining relatively flat. So as you look at the overall picture, with nitrogen fertilizer being a big expense item, especially in crop production agriculture, and fuel and interest, when you combine all of those items, we have seen a decrease in many of the cost items as we move through 2020 and look toward 2021. Looking specifically at the credit markets, overall loan demand appears to be stabilizing. You know, we saw sharp growth in loan demand, particularly the short-term borrowing, the operating loans, sharp spikes in 2015 and again in 2018. Here in 2020, loan demand appears to be stabilizing, partly because some of those government payments have helped mitigate the need for additional loans. New originations have slowed and certainly are below the trend line and below the 5-year average based on information from the Federal Reserve Bank. Average loan size is still increasing, but the number of loans being requested is decreasing at a pace that more than offsets the increasing size of the average loan. Average loan size increasing is probably more of a reflection of just continued consolidation in the ag sector, just continuing growth in the average size of farms. But again, the reduction in the number of new loan requests is more than offsetting that increase in the average loan size. And again, just to reiterate, we thought we were headed up in interest rates a few years ago and maybe even on into very early 2020. But interest rates have decreased rapidly over the past several months and are at historically low levels, as everybody's probably aware. That's a big positive factor when we look at the farm financial picture. Cash flow issues, we've talked about that at the Rural Economic Outlook Conference and in other settings for the last several years, really for the last 6 or 7 years. We've seen increasing concerns about liquidity and cash flow. Cash has been tight, margins have been tight, while balance sheets have remained relatively strong. Most farms in a pretty strong equity position. We've just seen a deterioration in liquidity for many, many years in a row. And that appeared to be continuing as recently as the spring of 2020. But here very recently, and the new information indicates that the liquidity issues appear to be significantly improving. Cash flows improved late in 2020. And some of those liquidity issues don't seem to be nearly as big a deal now as they were even just a few months ago. Again, in large part because of the government payment infusions, but reduction in costs has helped, as well as improving crop prices. When you translate that to a related measure, loan repayment challenges, data from the Federal Reserve Bank again indicates that loan repayment challenges appear to be easing across most farm types. That's especially true for our corn and soybean farmers up in the Midwest and the Corn Belt states. However, pertinent to Oklahoma and the Southern Plains, loan repayment challenges appear to still be a factor and a significant factor for our wheat producers, our stocker cattle producers, and our feedlot operations. So if we kind of view that in the aggregate, we would have to conclude that the most recent information suggests that repayment challenges might remain a concern in Oklahoma specifically because what do we produce a lot of in Oklahoma? A lot of wheat, a lot of stocker cattle, and we have some connection anyway to the cattle industry more broadly defined, the feedlot industry specifically. If we translate that to a broader measure that we look at over the long haul, land values in most of our region, most of the Southern Plains, have been slowly increasing throughout 2019, continuing into 2020. Very modest percentage increases in land values. I'm not sure that that's true everywhere, specifically a region I'm very familiar with. If we were to look at north central Oklahoma and maybe south central Kansas, for example, I'm not sure that we would see much of an increase in land values yet, but certainly not much of a decrease either. But overall, as we look at the bigger picture, there seems to be some optimism out there, maybe stimulated by lower interest rates, maybe stimulated by some other factors. Seems to be a little bit of optimism in the overall land market. So those are data-driven observations. We also have some other information that we can pull from that relates more to how farmers are thinking or how farmers are feeling at various points in time. One good indicator of that is the monthly survey conducted by our friends at Purdue University Center for Commercial Ag, managed by Dr. Jim Mintert, on a monthly basis. The Ag Economy Monthly Barometer, where they survey 400 producers across the United States, again, somewhat heavily weighted toward the Corn Belt producers, but not exclusively. They do survey a broader range of producers, not the same producers every month, so a different survey group every month. And they just ask them basically how they're feeling about a number of different issues that pertain to the current state of the ag finance situation and their expectations for the future regarding ag finances. I'm not going to get into a lot of detail about the specific questions that are asked on a monthly basis, but it is a good indicator of how people are feeling at any point in time. The index, both the index of current conditions and the index of future expectations, swings up and down, dramatically swings up and down a lot faster than the actual data changes pertaining to ag sector finances. We're driven, I guess, as human beings by recent news, recent feelings about what's going on in the world. So when bad events happen, like happened early in 2000, we see dramatic swings to the downside, both in perceptions of the current ag situation and in expectations for the future. And conversely, when we start to get some good news, when things start to improve, we feel better about the world at a faster rate than the actual data are improving. I think that's one of the things that Dr. Mintert and the folks at the Center for Commercial Ag would agree with the assessment that these surveys that dig into producer attitudes swing faster than the actual data would suggest. But with that said, in the most recent survey that just came out at the very end of October, actually based on October, the survey came out in early November, the highest level in the history of the survey, which goes back about 5 years, on both the index of current conditions and the index of future expectations. So the moral of the story is there's a lot of optimism out there in the ag sector And that optimism has come about very recently and very rapidly from levels that were almost at historically low levels just a few short months ago. We can look at some individual components of that survey that are kind of telling. Uh, Producers' attitudes toward investing in buying big ticket items. Again, the highest point on the survey in really history. Farmers are thinking about buying stuff, machinery in particular, and capital investments. And look at how rapidly those feelings have changed just in the last few months, going back to March, April, and May of 2020. If you ask survey respondents how they felt about buying machinery in the upcoming year relative to how they felt historically, you had a whole lot of respondents saying, I'm not very excited about buying machinery. And you had very few respondents in the green saying, yeah, I'm feeling better about buying machinery. Again, this is March, April, May, maybe even on into June of 2020. Look at how rapidly that has changed just in recent months. As we look at September and October of 2020, you have a lot fewer respondents saying, I'm not very excited about buying machinery and equipment. And you have a fairly dramatic increase in the number of respondents that are saying, yeah, I'm kind of excited about looking forward to buying some new machinery. Now, of course, we don't know whether that's because their financial situation has improved or because they spent the whole summer sitting on broken down machinery that kept breaking down all summer, and they're just so frustrated that they're ready to jump out and buy some new machinery. But at any rate, producers are feeling a little better about the prospects of making large long-term investments. Another thing that we're more positive about, if you compare January of 2020 with October of 2020, you're looking at a lot more producers in October that are thinking that the China trade situation is going to result in continued strong exports to China. You're looking at a big difference in that versus just a few short months ago, or even 1 month ago, I'm sorry, just looking at September 2020 versus October 2020, a dramatic increase in the number of respondents that think we're likely to get dramatically improved trade with China and they'll fulfill their requirements outlined in the trade agreement versus a month ago, where we had a lot more people thinking it was unlikely that China would fulfill those commitments. So a lot of optimism on the trade side that has just come about in the last month or so, perhaps brought about by significantly improving crop prices as a result of the realization that there are pretty strong exports taking place moving into the China market. Don't know what that means, but it means one thing that it does mean is that there's quite a bit more optimism out there. As we look at Oklahoma and just kind of combining the facts with the reality that we live in Oklahoma, we have to look at our mix of producers. We have to look at our crop producers versus our livestock producers. If any of you have attended the Rural Economic Outlook Conference for the last several years, or have heard maybe some of us talk about the financial situation outlook for the last several years, at least in Oklahoma, it's been the crop producers that we were more concerned about. The margins in crop production were very tight or even negative for most of the crops that we produce in this region of the United States. And the financial situation just continued to get tighter and tighter and worsen for our crop producers, as opposed to that same time period, the last several years, where our livestock producers, primarily our cattle producers, appeared to be faring fairly well. and weathering the storm, period of fairly strong prices, low feed prices as a result of the low crop product prices, um, helping out particularly our cattle producers. Here, as we move through 2020 and look forward to 2021, it looks like the fate of the two various distinctive groups of producers in Oklahoma may be reversed. Our crop producers look like they're having a pretty good year in general in 2020, and the outlook for the future looks a little brighter, whereas our livestock producers have struggled by and large through much of 2020, and the outlook for the future is a lot more uncertain. And we can just see that just by looking at graphs of the prices of those respective types of commodities. Here I'm using slaughter steer prices as a proxy for all cattle prices. Of course, there's some disconnect there based on feed price situation and timing, et cetera, et cetera. But by and large, our calf and feeder cattle prices all stem from what's going on in the slaughter cattle market. And if you look at both 2019 in the purple, 2020 in the red, prices have been well below the 5-year average. And particularly in 2020, we saw some very unusual price patterns brought about by concerns about the pandemic and shifts in the overall meat and meat product markets and a whole bunch of things going on there that were not very favorable to our cattle producers. So we saw a lot more fluctuation and a lot lower prices in general in 2020 than even we saw in 2019, both well below the 5-year average. So some much more difficult times for our cattle sector. Time will tell how that's going to play out as we finish up 2020 and move into 2021. At the same time that we were seeing relatively challenging times for our cattle producers, using that as a proxy for all livestock producers, because that's the major one here in Oklahoma. If you look at what's going on in the grain markets, just kind of the last couple months, really since about early September, a dramatic rebound in many of our grain markets, spurred by reductions in projections for domestic production and very positive news on the export market front. We've seen, for example, soybean prices just absolutely skyrocket. Another one that would be a good example would be grain sorghum prices, just absolutely gone through the roof in a very short time. Wheat market, not quite as dramatically, although we have seen a rebound over that same time period, not nearly as dramatic of a price rebound, but certainly positive news is better than a negative price move, just not as dramatic in the wheat market as we've seen in some of the other grain markets. So as we close out 2020, individual farm financial outcomes are going to depend on a lot of factors. Am I primarily a crop producer? Am I primarily a livestock or cattle producer? What's going on with local conditions? That's always a factor. Parts of our region, parts of the Southern Plains, parts of Oklahoma just seem to always have production problems. That moves around the various parts of the state, drought, flood, early freeze, you name it. So that's going to drive individual financial performance. And if even among the crop producers, the cropping mix makes a big difference. Am I primarily a wheat producer, or am I a producer who produces soybeans, grain sorghum, some of the other crops that have had a more significant price rally just over the last few months? Overall, the general trend is likely to be an improvement over recent years. I think that would be true for the general mix of producers that we have in the Southern Plains, as the new year comes in, a lot's going to depend on progress in mitigating the pandemic. That's probably going to be more of an issue for our cattle producers. The cattle market's going to be more sensitive to what's going on with COVID-19 and the pandemic and society's responses to that. Probably going to be more of a factor in the livestock markets than in the cropping markets. And again, just coming back to a point that's been made a number of times already, keep in mind that a significant contributor to the financial improvement that we've seen in 2020 is that almost historic influx of government payments that we saw in 2020. And so the question is there enough improvement in other factors, reductions in costs, improvements in crop prices, etc., to keep the overall improvement going and on track, even if, as we would project, there's a substantial reduction in overall government support over the next year or over the next few years. I think it's almost a given that the level of government support, government infusion of cash into agriculture will probably slow significantly in future years, including 2021. The question is going to be how much, and if the improvement in crop prices and maybe, hopefully, an improvement in cattle prices will be enough to make up for part of that reduction in government payment influx into agriculture. If we look specifically at some enterprise budgets, the crop budgets look more positive for 2021 than they did a year ago or than they have for several years. On a relative scale, just because of the magnitude of the price moves, grain sorghum looks pretty attractive. I know we've had some incredibly positive basis for grain sorghum here in the fall of 2020. Some market outlooks are starting to bid pretty aggressively for 2021 grain sorghum. Certainly not at the levels they're bidding for 2020 grain sorghum, but they're making basis bids that are a lot stronger than the historical average. Soybeans look like a bright spot. We could lock some of that in here before 2020 even comes to an end if we wanted to. So those crops look particularly attractive. The wheat budget projection looks better than it did a year ago, but on a relative scale, not quite as attractive as maybe some of these other crop possibilities. Cattle production budgets appear a little bit more challenging at the moment because of that lower price level than the 5-year average. And again, as mentioned earlier, the cattle production budgets are going to be a lot more sensitive to broader economic conditions. That final market out there is a lot more sensitive to a lot more things than the grain markets appear to be. So to kind of summarize, the overall ag sector financial situation is improving. There's still reasons for concern, and there's the potential for rapid swings in the financial well-being of individual operations. Oklahoma producers are weathering the storm fairly well in general. Of course, we all know of exceptions. We all know of individuals that have just found themselves in a bind that's hard to get out of, sometimes due to factors completely beyond their individual control. I'm concerned about the reduction in government payments as we go into 2021. Whether crop and livestock prices will be strong enough to offset that reduction is yet to be seen. We'd ask you to complete the survey. That's going to show up in the chat box. The direct link to that is going to show up in the chat box. Here's the website. I'm going to stop sharing my screen before you have time to write that down. So look in the chat box for the link to the survey. Again, we do have our Ag Finance quarterly newsletter. Send me an email at the email address there on the screen. If you are not already signed up for that and would like to get signed up for that, we've signed up several new individuals over the course of the last year or so. We also have our OSU Farm Management Facebook page that's being updated on a very regular basis with current contemporary information that we hope is of interest and useful. With that, I'm going to stop sharing my screen and I'll look for questions in the chat. Be sure and fill out the survey that you'll find Brent has posted in the chat. So if you have any questions, you might be able to unmute your mic and ask. Otherwise, ask them through the chat. And I'll be on for a few more minutes to answer any questions.
Thank you, Dr. Jones. Yeah, I did set it where people can now ask questions through the chat box. So yeah, feel free to enter your questions now. And the link, you can click on it directly to fill out that survey for us. We also, I'll take this moment to let everyone know, we have another Outlook webinar scheduled on December 15th at noon. And in an Extension Farm Policy Specialist, Dr. Amy Hagerman, will provide a farm policy update at that time. So that's the next one. We have several more running through January and February. We'll do a grain market outlook, and then a series wrap up in February. Also, that one will also be an update on the COVID-19 situation in Oklahoma as far as economics. So if you have any questions, please feel free to enter them into the chat box, and Dr. Jones will be glad to answer them for you.
Can I make a comment, Rod, real quick?
Absolutely, Larry, go ahead.
I do not intend this to be a political comment, but I have a chart that goes back through the entire 20th century on net farm income, and most of the time during Democratic administrations, farmers do better on net farm income than during Republican administrations. So I found it very interesting that the optimism started up in that survey even before the election. I have never been able to explain why the net farm income goes up. It's something that I've wanted to research, and I've never found the right kinds of questions to ask without people getting irritated about it, because it is, by its nature, political. Kim and Daryl and I, years ago, followed up Leo-Blakely on looking at that, and it is almost always the crop people benefit. Livestock, it isn't quite as certain for the first couple of years. Sometimes they do better under Republican administrations. I just wanted to throw that out.
Thank you, Dr. Sanders.
Anybody else, feel free to unmute your mic and ask a question or ask something in the chat box. If not, we'll take just a few more minutes here and then we'll probably close off. But don't hesitate to ask a question if you have one.
Hi, Rodney. I have a question. It's kind of, again, more of a statement. You and I have talked about this a little bit. So how would you recommend that people consider these farm payments when they're evaluating their financial performance for this last year?
That's a great question because if you're evaluating farm performance for the last year or planning for the future, um, I would plan on a significant reduction in government payments over the next year or so, down to levels that are guaranteed by farm bill contracts. For example, if you're in ARC or if you're in PLC, or whatever the case may be. Of course, if you're in PLC, you kind of have a little bit of a floor on prices, et cetera, which is more kind of like an insurance policy. But I would certainly run those budget projections, and that's what we do when we're looking at the enterprise budgets. We do not have a government payment component in there, and we try to see if we can make things work and continue to move forward financially without a substantial influx of government cash. Not to say that we won't welcome it if it happens, and of course 2020 was certainly a strange year, and justification could be made regarding trying to mitigate the impacts of COVID-19 that were nobody's fault. There was a lot of government infusion into a lot of industries and a lot of individual household budgets. So not really trying to make the argument that that it isn't needed or sometimes justified, but it's always a political decision when it gets beyond the amount that is guaranteed by some contract payment due to a farm bill or something like that. Anything above and beyond that is subject to political whims.
I still don't see any other questions, so I think we can wrap it up, Dr. Jones. So thank you everyone for joining us today, and we will see you on December 15th at noon for our next webinar. So until then, goodbye.